Welcome back to another episode of the widest moat you've never heard of, and we have the best one yet. No exaggeration, I just finished recording it. I am 59 minutes into the recording here. I was initially going to make this a Patreon exclusive, but as I made the video, I realized just how special of a business we have. I don't mean to spoil it for you, but I think we've stumbled upon the widest moat company on earth. And there's like FICO, S&P Global. I did a video actually about a month ago called the top 10 moats of all time. I gave honorable mention to GE, which is, like a competitor to Safran. But I mean, if we were to go back and re-rank that, I would put these guys like number one, number two. It's up there. To give you a bit of a teaser, to get you interested, it's like if you, in my opinion, it's like if you combined the ASML business, gave it more reoccurring revenues, and then layered in, actually, I won't spoil that last part. Watch until the end. You will be so shocked. I'm very excited for you guys to watch this video. Leave me comments below about what you think. And yeah, I know you will like this deep dive, so enjoy. Safran. I gave a bit of a hint in one of the recent videos. Pretty sure it was this one. And if I do say so myself, I did give like a pretty compelling pitch of like, this is like an ASML level moat. The industry is like, there's literally like two competitors. I actually can't remember what I said, but like super steady business, like great secular growth. It's necessary to the existence of the world, so on and so forth. And I think the best way to kind of go about this, to kind of give you a starter, I'll kind of explain what they do, I guess. But basically, Safran makes jet engines. And that's pretty much it. They do some other things. They have like a defense segment for like military purposes and stuff like that. But like 70% of the business is jet engines, and they specifically make narrow body jet engines. It's a French company, and the market cap's about 120 billion euros. By the way, narrow body versus wide body is just like these two. Oh, the best pick. Basically just single aisle versus, two aisles, right? And this is 6 seats versus 7 seats usually. In some cases with some of the bigger Boeings and airplanes and stuff like that, it's 3, 4, and 3. So that's 10 seats across, right? So they specifically focus on the narrow body, which is that single aisle, any of the single aisle airplanes. And basically the way the industry works is airlines, or I should say aerospace as a whole, grows at a little bit above GDP. It's like GDP plus a couple percent. And then narrow bodies are becoming more and more popular over time because they can, at least with the technology we have today, like they could basically go anywhere. They go about 9,000 kilometers, right? So 9,000 kilometers can essentially get you to a lot of places. It could definitely get you from like most of North America to like most of Europe. I think the only sort of flights that it can't really travel is like, Sydney to Toronto direct, or something like LA to like somewhere in the Middle East, right? Like that those type of super long distance flights, I don't think it could go. Anyways, point is, it could travel most of the world, and like it's more cost effective for these airlines to go for narrow body airplanes as opposed to wide body, just purely based off like maintenance and fuel costs and stuff like that. They're easier to fill up as well, so you have less risk of seat vacancies and stuff like that. So it's overall it's a better package for these airlines to be ordering narrow body for their fleet as opposed to a wide body. Anyways, now that you know what the company mainly does, they make the jet engines for that. I'll kind of read you the pitch from Value Investors Club. This is from actually earlier this year, February 3rd, 2025. This kind of gets us through most of the thesis. And by the way, heads up, we're going to do a bunch of reading throughout the video today. So kind of a disclaimer for that, but it's for good reason, right? And so just for the sake of your eyes, I've put this in a Google Doc so that it's a little bit nicer on the eyes. Well, we'll read this, and I think, it touches at like most of the points of why this is a very powerful business. It's a very concise and straightforward pitch. So Safran is an attractive long-term investment due to its dominant position in aerospace propulsion and strong aftermarket growth. The OEM business, which represents half of Safran's revenue base, is a concentrated industry with very long structural barriers to entry. So that's the first source of moat, very strong structural barriers to entry. There are 3 engine OEMs that supply almost all large commercial aircraft engines: GE, Pratt & Whitney, and Rolls-Royce. There are many forms of partnerships in the industry, with Safran and MTU as JV partners. I'm not sure what that is, to the OEMs. OEMs, by the way, is just original equipment manufacturers. So, Rolls-Royce, Pratt & Whitney, General Electric, these are all considered just equipment manufacturers, right? The business model of the aircraft engine industry is to sell new engines that go onto the new aircraft produced by Airbus and Boeing. Part of the barrier to entry is that large amount of upfront investment costs needed to develop a new engine program. For example, it is estimated that Pratt & Whitney's program cost for the GTF engine was around $10 billion But beyond the large upfront capex, the engines need to be selected by aircraft OEMs, which themselves go through a large safety and regulatory certification process. So a couple things. One, huge barriers to entry, just purely based off the sheer upfront investment of getting into the business. But then once you've made an engine, it's not like there's, it's not like Chipotle where like there's just customers walking right in front of your door ready to pounce inside the store and buy a Chipotle bowl. No, like that engine model needs to be selected, verified, assured from a quality perspective, from a regulatory perspective, everything like that, by Boeing and Airbus and, all the regulatory bodies involved in there for them to even think about incorporating that engine into one of their models, right? So you're starting to, see there's multiple elements of having a business here. In order for you to participate in this business, there's multiple people that need to kind of sign off on it, and that's after you've put a $10 billion investment. I should preface, by the way, obviously I'm not some aerospace expert here, so I'm sure some of you like work in the industry. At multiple points throughout this video, there's probably going to be moments of like, what is this kid talking about? And like, fair enough, like I don't know the insides and out, but this is just kind of my understanding of things. So just bit of a preface. Give me some leeway here, right? Okay, and then this is pretty important, right? They say the most attractive part of the business model comes from the visibility. Once Airbus or Boeing selects a particular engine for its aircraft, that engine program is often locked in for the lifetime of that aircraft. And this completely makes sense. Once you choose an engine for that model of aircraft that you're going to be making, for basically the entire duration of Boeing making that aircraft, they're not going to go back and change it around because they've literally built it for that to match. And I heard this thing when they buy secondhand jets to like kind of strip out the like secondhand commercial jets to strip out the insides and like make it like luxurious and stuff like that. It's not as simple as like we'll strip out the interior and redo it. There's like certain like weight balances and stuff like that like you need to meet. So it has to be very precise the way that you like change anything that comes with these airplanes. Otherwise, it's literally not safe to fly. And I would imagine to a very large degree, this applies to the literal engine of the airplane as well. It's not like you just, you change the Safran one for the GE on or whatever. That entire plane has been designed to fit the GE or the Safran engine. And, we have countless examples of this throughout history. For example, the A320 CEO, the first engine delivery was made in 1988, and the final delivery was over 30 years later in 2021. The last of the fleet will likely fly into the late 2030s. So I think this is a Airbus plane here. This is in fact an Airbus plane. So somebody in 1988 decided to choose the Safran engine for the A320. 30 years have passed. They made the final delivery of that for to Airbus. And then obviously these planes typically run for at least about 15 years. So we'll see, those A320s run for another 15, 20-ish years. That gives you a life cycle of about 50 years. That is literally, that's like a human life. This entire process is a literal human life. And I'm kind of skipping ahead in terms of the details here, but like you might think like, okay, like once they kind of sell that engine and they make the final delivery, then that's it. That's like the business. But they make reoccurring maintenance and servicing and fixing and repairing these engines. So when they lock that contract in the 1980s, they essentially have signed a 50-year agreement of making revenues off of Airbus. Take that in. That one single decision in 1988 has locked in 50 years worth of future revenues. And so this is all like, we always kind of like joke about it. I wouldn't say joke about it, but it's like an interesting thought experiment of like, what discount rate can you place on infinite cash flows, right? Discount rate, like obviously, if you're doing like a DCF, you have to put like a quote unquote discount rate or like a terminal growth rate or whatever. So it's like, in this case, it's literally infinite cash flows because this company they're contractually obligated to make revenues for 50 years. If they sign a contract for the newest A330, for example, we have great visibility based off of history and the fact that humans will continue to fly, that Safran will generate revenues off of that contract for the next 50 years at least, right? Like ridiculous. And so this is the key. This is the key with the thesis. This is the key with the business. So essentially, the business model is to sell new engines, to build the installed base, and then make the profits on the installed base by monetizing the aftermarket. A lot of fancy words there, but basically, it's the razor and blade business model. Classic razor and blade business model of, You sell people the razor at like next to no profit, but then like you sell them the razor for like $3, whatever. But then you essentially get reoccurring revenue as long as they stay with that razor, technically, right? Like as long as they have that razor, they'll come back and buy razor blades from you to be able to shave and do all that stuff, right? Except in this case, the jet engines that they're selling them is not just any razor. Once you choose that jet engine, you're stuck using it until you decommission that plane, until you stop making that plane. You have to use the same jet engine for those planes, right? And then I believe, I don't know the exact details of it, but like I believe you can use other people for servicing and repair and stuff like that. And I'll get to this later in the video of like how they're doing the new contracts. But I'm almost certain in the new contracts, it's like you literally pay for a subscription of like you're paying a monthly amount to have these Safran engineers on call to be able to come in and like repair the engines for you and stuff like that, right? But yeah, you're essentially selling the engines for very little profit to be able to make a reoccurring revenue off of that installed base of engines or those planes, right? You service them, you repair them, you do all that great stuff, and you make a really high margin servicing revenue at a later date. Safran is a global leader in narrow-body aircraft engines primarily through its 50-50 joint venture with GE Aerospace, which is called CFM International. The wide-body market is dominated by GE and Rolls-Royce. CFM has a 75% market share of the narrow-body market, 100% market share of the Boeing 737s. That's probably the most popular plane ever is the Boeing 737, or is it the 747? I don't know. I'm sure, most of you watching this have flown on a Boeing 737. If you have, a Safran engine was powering you to be able to go through the skies. 60% market share of the Airbus A320, which is, like the other narrow body, super popular plane. CFM produces two engines, the CFM 56, which powers the A320 and the 737, and dominates the installed base, while the new generation LEAP powers. These are the new engines that they're working on. They offer a different variety of the A320 and the 737. And this is what is driving the installed base growth. So there's a big shift towards these LEAP engines as opposed to the CFM 56. CFM 56 is like the old generation. You could think of it, if we were to give the ASML analogy, the CFM 56 is like your DUV machine, and then the LEAP engine is your EUV machine. With LEAP, Safran has 100% of Boeing's narrow-body backlog. That is incredible. And close to 2/3 of Airbus's backlog, which translates to close to 85% market share of total narrow-body backlog. So when I said up front of this is like an ASML-esque business, you have it in the numbers. They have 85% market share. ASML has 90% market share in what they do. The numbers are not that far off. And then you add in the fact that like the nature of the business, selling big, bulky hardware and make servicing revenue afterwards. In the case of, and we'll read it in a second here, but in the case of a Safran, it's actually to a further extent. ASML, and we can pull it up, but they only make about 25% of revenues from servicing and repairs and stuff like that. Safran makes 70%. So they're really selling you these engines for pennies on the dollar to be able to make that high margin servicing repair revenue, lock in those long-term cash flows of essentially getting a subscription for repairs and for servicing, right? From a secular growth point of view, industry tends to be levered to global air traffic, which is expected to grow at 2 times GDP, ensuring continuous demand for new aircraft and spare parts. From an OEM standpoint, both Airbus and Boeing have large backlogs of orders, which keeps engine demand strong for numerous years. I think in the case of Boeing in specific, their backlog extends to 2031. And again, Safran owns 100% of Boeing's backlog, specifically for narrow body. For other segments, it's different. But, a backlog that extends, 6 years out? Something like that. And you own 100% of that? Like, how much more consistent and durable of cash flows do you need? You know what I mean? I think ASML's backlog is like 2 years. And like we're, as investors, we're like raving about that, right? 6 years of backlog. You have that much visibility ahead into future years of growth. Truly, truly incredible business. And then you add on the fact of like the secular growth is a little bit above GDP and stuff. It's just fantastic. The true value driver of the business is the aftermarket business. This is 100% true, which makes up the remaining half of the business, but a larger portion of Safran's profitability. The main driver of aftermarket revenues is the number of shop visits, which ultimately is a function of the traffic activity for the installed base. As aircraft components accumulate hours/cycles, their performance can deteriorate as parts begin to wear and tear, which negatively affects performance. Fair warning, we're going to get into some wacky numbers and terms here, but I'll try to break it down as best as possible. Eventually, maintenance work will need to be done to restore the capabilities, or sometimes parts need to be replaced outright. There are some structural tailwinds to the aftermarket business, Aircraft retirement delays and low new aircraft deliveries have led to higher demand for maintenance services and spare parts. Do you see the inverse correlation of that, by the way? So it's if these companies delay buying new planes or they try to otherwise extend the life of their older planes, that doesn't necessarily spell bad news for Safran because they also own the repair business, right? So if one side of the business, like half the revenues, which is technically selling the engine parts, if that side of the business, quote unquote, takes a hit or is in a bit of a slowdown, the other part of the business in any given cycle should see a little bit of an acceleration because that means these customers are delaying upgrading to new planes or acquiring new planes in total, relying on the older planes, which means more servicing revenues. I hope I made sense, but I think you guys get the idea. Basically, trying to prolong older planes is bad because they sell engines for newer planes, but then it's good because they're servicing the older planes as well. So it should be pretty straightforward. More specific to Safran, its CFM56 engine, which dominates the current installed base, has not fully been monetized yet, as the age distribution of the second-gen CFM56 remains quite low at 12 years. The company disclosed that only 25% of the engines had more than one maintenance shop visit. Interesting. 30% had one shop visit, while 45% had no shop visits. So 45%, or almost half of the CFM56 engines, haven't even undergone maintenance yet. As a result, there's significant pent-up demand for maintenance services, as 75% of engine spare parts consumption are in the first two shop visits. Looking at the LEAP engines, they currently have minimum contribution to aftermarket revenues, as these engines are just about to reach aftermarket maturity. So yeah, on average, the LEAP engines are just starting to get to that like 7-year-old mark where they have to go in for the first shop visit. But maintenance and spare parts sales for LEAP will drive future profits towards 2026 and beyond, when the engines start maturing and the shop visits increase, providing good visibility on the ramp in growth over the medium to long term. One important distinction that for the LEAP engines, the aftermarket contracts will be on long-term service agreements. This is what I was talking about earlier. So this is very key to the thesis. Unlike the traditional time and materials model, I'll come back to that in a second. In these service agreements, the pricing is set ahead of time, so the original equipment manufacturer essentially takes on the downside risk if maintenance costs are above what is initially envisioned, thus providing some added visibility into Safran's cash. So, matter of fact, I'm gonna pull up a little Paint document here. I am on a touchpad, so excuse me if this is not the best. Okay, so this is the original method of how Safran and GE and whoever would typically make aftermarket revenues. And again, this is roughly 70% of the profits of this business comes from, once they sell the engine, servicing it. So to say it's like an important segment is kind of an understatement. It's the important segment, right? And so typically, how they used to do the contracts was they would essentially, to some extent sign like an exclusive agreement of like, okay, you buy this engine from us. Once it needs to kind of be repaired or come in for maintenance or have the spare parts removed so it meets a certain regulatory threshold, whatever the case is, you come to us, right? And so typically that's at year 7 and year 15 of the existence of that plane or technically engine, right? And so in this scenario, if there was an unplanned repair or something, if it shows up on their scanner that like, oh, the cooling system broke or something, or like in their routine checks, they're like, oh, this thing is scratched up, banged up, whatever, we have to go in. And it's like in year 4 instead of year 7, you have to take that plane in for maintenance. That's extra costs. And by the way, the airline pays for this, not Boeing, not Airbus. The airline has to pay for this because it's technically their plane. That's an unplanned repair, and that's good for Safran because that's extra revenues, and it's bad for the airline because that's something they hadn't planned for. It's like if your car breaks down outside of like the expected years or time that you expected for it to kind of break down, right? Or like if you have to do an extra oil change every single year as opposed to just one, right? Whatever the case may be. And so this model of things is the quote unquote traditional time and materials model. So they essentially just charge you based off of like what was changed. It's literally like as if you're taking it to the mechanic. When it breaks, they charge you based off the time it took to repair it, and they charge you based off the materials used, and that's it. And this is only when you go in. So obviously, like, you should technically go in for like a routine check every 7 years. Like that's also included. And, if you go in and like nothing needs to be changed or like only a few things need to be changed, they'll charge accordingly, right? This is, again, like, this is a pretty good arrangement for Safran, but not really a good arrangement for, for the airline, because they kind of get screwed every time you have to go in and you didn't expect to go in. The other model is they literally pay them a subscription, and this is how it works with the LEAP engine. And I'm going to remind you, LEAP engine is the newest way which they do it. Now, the new model, and this is, we'll put this down as 2, but it's called RPFH, Rate per flight hour. And it's kind of an insane agreement that they've came to. So mind you, there's 3 people involved here. There's Safran and GE, which make the jet engine. There's Boeing, or Airbus, whoever, and then there's the actual airlines. The airline, which isn't even a direct customer of Safran or GE, is paying Safran and GE for every hour that their plane flies. What a ridiculous arrangement, but it's to their own good. It actually benefits the airlines, which is just, again, ludicrous, right? Like, just so stupid. They're paying them for essentially nothing yet. Like, it's a service that they'll provide at a future date, right? So talk about like positive working capital. Like, this is a ridiculous case of that example. So again, like net everything, technically they probably make like less revenues. I'm talking about GE and Safran. It would probably be best for them from just a purely revenue standpoint if they were to do it under the, I believe it's called MRO model, or just the traditional method. I think is better for them because they net out with more revenues. But under this version, let's just take Delta Airlines or American Airlines. Delta or American Airlines on a quarterly basis or whatever is paying a certain amount, depending on how many hours that plane has flown, for example, during that quarter, to GE and Safran as like, it's essentially insurance. It literally is insurance of like, if this goes down, you have to come in and fix it. Now, the risk that this is fantastic for GE and Safran because similar to insurance, you're getting paid for something, for a service to be provided later. That's a huge amount of float. You could go reinvest that cash into whatever until at a later date, you do actually have to provide that service, right? And, you know, of course, everybody knows time value of money. Just so many great things are happening and at the same time here. I absolutely love it. And it is subscription-like, right? Like, it's not like, unless this airline literally shuts down, they're going to pay you that money. It's very high retention subscription. And again, it's not like they're going to just get rid of your jet engine. Fantastic. I love that. But the other point I was going to make is this agreement, even though you make less revenues, it's much better because you have that predictability of revenues consistently coming in, as opposed to like, oh, will we have a year 4 maintenance? Will we have a year 7 maintenance? Remains to be seen. So that aspect of it, the predictability of revenues is another nice thing to have. The only big downside for them is if there's essentially more accidents, or I shouldn't say accidents, but if there's more downtime than anticipated. So because they're paying a subscription and they're no longer paying for specifically the amount of time and materials used, they're just paying a flat subscription. Let's just say there's 3 downtimes in the first 7 years of this plane's existence. GE and Safran are on the hook for that, and they're probably actually going to lose money on that. So again, similar, you could think of it like an insurance company that can't raise insurance prices on you. So if you get into 3, 4, 5 accidents, they're on the hook for paying you back for those 5 cars. They're going to lose money on you, right? Like, it doesn't matter if you've paid them $10,000 in insurance over the past 5 years. If you get into 3 accidents, they have to cover $60,000 of car costs. They're on the hook for that. They're going to lose money on that. So similar sort of dynamic plays out for this. Net everything, I would say these new types of contracts that they're signing for the LEAP engines, and again, I'm going to remind you, LEAP engines are the way the industry is going. Those are the new generation of engines that is going to replace for most planes over the next 20, 30 years, whatever, right? The new method of these contracts is net everything, probably best for Safran because of that predictability of revenues that kind of smooths out everything. Anyways, moving on, because this video is running quite long. By the way, most of what I said in today's video applies to GE as well. As you can tell, like they do have like a joint partnership. So the only other difference is like GE dominates wide body as well, and they have a big military tilt as well. So, but I guess a couple nuances, right? But a lot of what I say applies to both of them. It wouldn't be Visa, MasterCard. I think the example would be closer to like a Moody's and an S&P, where like they share the indices business. They both kind of do analytics, and then they got like other stuff. You know what? S&P has other stuff. In this case, Safran is the Moody's, GE is the S&P, because they have like all the other stuff as well, right? Anyways, let's work through this. In recent capital markets day, management guided to grow revenues at a high single digit, while operating profit will grow at 10 to 12% and reach 6 to 6.5 billion euros by 2028. We think management's numbers are very conservative, as they're not fully recognizing the contribution from LEAP engines due to its decisions on how to account for LEAP revenues under IFRS. Based on our estimates, we think the revenues and margin contribution will be much higher from the after-service revenue segment. They're basically saying between now and 2028, they think a huge number of these LEAP engines will start to come in for servicing. If they start to come in for servicing, that's a huge boost to revenues, similar to how like ASML's kind of cyclical. Out of nowhere they might grow like 20 whatever percent. I don't think it's that extreme with a Safran, because again, they're way more subscription and servicing revenue as opposed to working based off of hardware. But still, you'll see like a big boost in revenues over the next 3-ish years in the event that this does come true, which I think it will. It's just how numbers work. These engines are supposed to come in for servicing every 7 years. 2026 is that 7th year. So we'll see. We think the revenues and margin contribution will be much higher from the after-service revenue segment, which will drive up overall earnings/free cash flow growth closer to 15%. Management has also committed to 40% dividend payout ratio and an incremental 5 billion euros of share repurchases. That looks to me like an 80% shareholder or 80% of net income going to shareholder, like not a shareholder yield, but like 80% of net income or whatever going to the shareholders. So that's nice, which brings the internal rate of return closer to 17-18%. I agree with these numbers. I think you'll have, the way I do my math is you'll have around 10, maybe low teens revenue growth with this business, which by the way, they're growing faster than that at the moment. I think, yeah, they're growing 14-15%, but again, cyclical business, blah, 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 whatever. This isn't going to necessarily continue, but I think they can probably manage that teens sort of revenue growth. Analysts are guiding for 13% revenue growth over the next 2 years. I think that's very, very reasonable. Again, like we're looking at basically a subscription business. Whatever management, well, the management's being conservative, but I think with a subscription business, the analysts have a pretty decent grasp of like where the numbers are going next. Of course, I'm not going to rely on that, but based off of what we've researched so far, based off of all the numbers and everything and what this research report tells us, I think that low teens revenue CAGR is very fair. I think that's an excellent projection of where these numbers will likely go in the future. You add on a little bit of margin expansion. We look at shareholder yield, which currently only sits at about 2%, but as of, not that long ago, it was like in the 3s. So at about roughly 2% shareholder yield, yeah, you're looking at like 15%, 16%, like a mid-teen sort of intrinsic growth in the business. And then if you get any sort of upside in terms of those LEAP engines coming in, that'll be pretty important as well. In that scenario, you're looking at like 20% internal value, like intrinsic value growth. Before we head off to do the valuations, I do want to read a quick section from the Morningstar Report. I was reading this on the plane, and I was reading it on a double lane Boeing plane. So unfortunately, definitely not a Safran engine. It was probably a Rolls Royce or something. But anyways, I do recommend, if you have access to a fiscal account, which you could get 2-week free trial for, by the way, with a fiscal account, you get access to the Morningstar Report, which is in of itself like a $300 subscription. But anyways, if you get access to it, read this report. Fantastic. I would read it and then go back and read it again. But the main thing I want to read from this section for you guys is really to kind of highlight just how powerful the moat of this business is. And so this section is under aerospace propulsion. And they specifically note, they say the segment has high barriers to entry, whatever, ranging from stringent regulatory requirements to rigorous safety, reliability, and durability qualification processes. Only 4 Tier 1 companies, including Safran, have the technological expertise and capacity to design, manufacture, and service large commercial aircraft engines. Safran leverages its market position to establish long-term customer and supplier relationships while protecting its margins by transferring pricing pressures downstream of the supply chain. So again, ASML-esque, very much. They have great customer relationships, they have great supplier relationships, and they have this like crazy complicated supply chain of being able to put all this together. And then in addition to that, ultimately, their customers don't pay for any price increase. The customers of their customers don't pay for any price increases. It's like way later down the line. You know what I mean? The production of engines requires significant capital upfront, extensive R&D investments, and skilled workers. Safran has 86,000 employees. 15,000 of them are dedicated to R&D. This is big tech numbers in terms of people dedicated to engineering. Very talented workforce. And this is just from the years 2015 to 2020. But these companies combined have invested $16 billion in R&D between Safran and GE. And then this compares to $8 billion for Pratt & Whitney and around $7 billion. Again, this is like big tech levels of investment. This is serious business here. And then on top of that, they have a huge amount of intellectual property. All of these companies have their own specific designs and stuff like that is decades old that they legally own. So that adds in another layer to the moat, similar to an ASML who also owns a lot of IP. Safran in specific has the most amount of IP, and as of the end of 2022 holds a patent portfolio of more than 50,000 intellectual property rights worldwide, protecting over 14,000 inventions. That's just truly remarkable. The company's portfolio is focused on growing the narrow-body segment. We already know this. They have a 72% market share there. This is the fastest growing segment within the aerospace industry. An interesting point is the delivery of new engines initially hurts operating profits, and even at a mature stage, they generate low margins with break-even, and the break-even point tends to be 10 to 12 years after they initially sell the engine. So talk about barriers to entry. And I mentioned this in the chat in our Discord. This is what I said. I said, bar none, one of the most quality businesses I've ever observed. No kidding, it's such a big position for Chris Hone. The product cycles are 50 years long, and it takes $10 billion of investment for 10 to 20 years before you make a meaningful return on your investment. Not even big tech would play ball here. I wasn't exaggerating when I told you guys this. That's literally how long it takes to be able to see a return on all of that R&D you're dumping in. So there's a huge negative cash conversion cycle, meaning you have a huge cycle of having to put up this upfront investment in terms of R&D, CapEx, everything in between, customer relationships, all this other garbage, huge investment you have to put there. But then once you do, you kind of earn the right that like at a mature stage, for example, with the CFM56 engine or the LEAP engines now, right? Like once they've been made and stuff like that, you essentially act as an insurance company. So huge barrier to entry, but once you have entered, you could be almost like this monopolistic bully that charges just because. So it's just such a fascinating business. And then I said, not to mention you need supplier relationships to make the damn engines, the customer relationships to meet their quality standards, to even be able to start selling and, somehow convince them that like you should choose our engine over the competitor. Oh, and did I mention the governments of 200 companies are up your ass about ensuring safety the entire time? Half jokingly, I said, I think it'd be easier to compete with Amazon and e-commerce than this. But yeah, like you're getting screwed from a million angles, whether it be investment to get in there, whether it be convincing the customers to buy you, whether it be meeting the quality bar and the safety bar of 200 different countries. You're just screwed at all angles, and it requires so much technical know-how, and you need decades and decades of investment. It's simply impossible for any new company to enter the industry. The 4 companies that already are there, they'll continue along. I even doubt it if Pratt & Whitney, which is owned by Raytheon, I believe, I highly doubt it that they would be able to break into the narrow body space, because they'll sit there, they'll be like, oh, Safran owns this market. It would take us 10, 20 years for us to break into this market. Screw it, whatever. No, we'll just do what's already working. The investment cycle is just too long for them to even think about it, right? Again, there's so much more great stuff in here that I would want to go through, but I think you guys are starting to get the idea. It's such a powerful business. Okay, I will include this other thing because I think this is very, very interesting as well. I didn't even know this until I read this just now. So, okay, Morningstar says that 80% of the aftermarket revenue is derived from sales of spare parts to third party companies, not even their customers, but to literally just other companies that repair the engines. And so I didn't actually know this. This adds another layer to the moat. It's starting to get interesting. So I was under the impression so far that when you sell them the engine, Razor and Blade model, those airlines would just come back to you under exclusive agreements and whatnot, and they would get the servicing. But what I'm understanding now is from that 70% of revenues of this business, about 80% of that, smaller pie, they're literally selling it to just random companies, random repair shops. Third party, MRO stands for maintenance repair and something else. Right? Just third-party company. And so Safran can act like a bully even more on these third-party MRO companies, because these companies can technically go out and make their own parts and stuff like that and use that for the repairs. But 2 things. 1, it's illegal to do so. 2, if you actually use the original spare parts that is made by Safran, the residual value of that plane is higher. So meaning, if Airbus or whatever airline, if Delta wants to sell that plane after 10 years, if the service history shows that it was changed with original Safran parts, that plane is worth more than if it was changed with random third-party parts. And then if a third party is interested in developing and manufacturing engine spare parts, needs to be PMA certified by the Federal Aviation Administration or European Union Aviation Safety Agency. Jesus. To do so, it either must prove that the PMA part is identical to the original part, or get from the original manufacturer the rights, data, and drawings to manufacture it. Long-term RPFH agreements are expected to represent 60 to 70% of the installed LEAP fleet, supporting even higher switching costs. By using long-term service contracts, Safran can increase the aftermarket margins for any quality improvements and leverage the close relationships with its clients to renegotiate after market spare parts services, especially for high value components at contract termination. This adds another layer to the moat. For these companies to meet these aftermarket companies to meet the regulatory restriction, they again either need to prove that that part that they made is just as good as the part that Safran makes, which I don't know, that's up for debate, or they need to license the rights, data, and the drawings to manufacture that exact part from Safran. And they just said that they expect 60 to 70% of the installed LEAP fleet revenue. So again, if we back up a little bit, they make 70% of their revenues from just servicing as a whole. A smaller chunk of that is just the LEAP engines, and then an even smaller chunk of that is these service contracts, but still a very meaningful amount. Safran at this point is not even an engine business. It's a licensing business. They're licensing the rights of these companies. We're getting closer to like, you know, ARM Holdings and like Synopsys with their IP, licensing out their IP, licensing out the blueprint of how to make these chips, licensing out the blueprint of how to make these specific parts for the engine, right? And then the key to this is they're kind of locked in once they start making them. So when the contract gets terminated and it comes to renegotiating, what are you going to do? Not make them? Yeah, so you're going to run out of business. So I'm sure they're, you know, increasing the prices on that like crazy, and that is just pure margin to the bottom line of the Safran shareholder. So what we have in front of us, ladies and gentlemen, is in fact the ASML business model, except it's got a layer of subscription to it. 70% of revenues is reoccurring and has a subscription nature to it. Layer in from that subscription portion, a part of it doesn't even have to do with the repair of the machine. It's licensing out the rights, the data, the know-how of how to make specific parts of the engine to other companies. I am speechless. So we have like a merge of like ASML if it was more subscription revenues, and then like Synopsys if it, because, you know, Synopsys licenses out its IP. Or a better example is like ARM Holdings. And this company trades at the eye-watering valuation. We'll do PE. We'll do PE because PE is a fun one. The eye-watering valuation of 27 times earnings. A company that is growing earnings at about at least 15%, has the moat that I just described to you over the past 40 minutes. I would argue has a wider moat than ASML. I said it. A company that is at least on par with ASML in terms of moat trades at effectively 25, 26 times earnings. Ladies and gentlemen, I present to you the widest moat you've never heard of. I'm genuinely speechless. I hope you enjoyed this. As I showed throughout the video, I do have a Discord. It's the only way to support me. I'm like this exact video, this stock pick, everything came from the Discord. Big thanks to Arun, Cashflow Farming, CapEx and Chill, these guys in here, they brought this stock to my attention. The reason we did this video today, the reason you're watching this video today is because of them and because of the Discord. If you haven't joined the community, give it a try. It is the price of a literal coffee. It is $3 a month. We talk about stocks like this all the time. We're doing deep dives on them, bickering back and forth, having a great time. We're so close to 300 investors in there. So, you know, you're essentially paying for a network of people in there to kind of hang out with. I think at least I know me personally in my real life, I have people that invest and I know them that are my friends and stuff like that. Not to this degree. We're not all nerds sitting here for an hour watching Safran deep dive. You know what I mean? So it's like, if you've made it this far, you would be the right fit for this type of Discord. Go ahead, give it a try. There's a free trial for it. And then additionally, Fiscal AI, we briefly used it throughout the video. So that's always nice. You could give that a try. 2-week free trial, no card required. And you get access to like Morningstar Report and stuff like that. So that's always nice. But yeah, thank you very much for watching. I will see you inside of the Discord server. Have a great day. Okay, I just finished recording. This is going to be so weird on the recording because you will see me, for me, I just recorded the intro of the video after doing the hour-long deep dive, and then I'm putting this clip at the end. So it's like Inception over here. Funny. Anyways, the one thing I forgot to include is, am I going to be buying the business? The answer is no. Not yet, but I'm so interested in buying the business eventually. I have a pretty big ASML position, and ASML is actually kind of getting up there in terms of valuation. I was thinking about it today, and I wouldn't trim or sell this business until it gets to like 40, 45 times EV to EBIT. And for it to get a 40, 45 times EV to EBIT, we're looking at like, I think it's like a $1,600, $1,700 stock, assuming like I'm talking this quarter, like assuming the earnings don't come out and the revenues don't accelerate or whatever the case is, right? So moving target is what I'm kind of saying with that. And I have no reason to sell the business. ASML, I've done so many videos on. It's such a fantastic business and opportunity and everything like that. Very similar to SAF. And then in addition to that, even though I just told you it's like a 24 times, 25 times earnings multiple, and like that's pretty cheap. Historically, it has been cheap. And so I'm not in any type of rush to like open a position right away just because I love the moat so much and this and that. And perhaps I'm being greedy and stuff like that. But I would appreciate a little bit lower of a valuation for this business. And maybe it just permanently deserves to be re-rated higher as a higher valuation business. I don't know. It is, like a higher margin business than before. Okay, maybe not. But it's definitely like a wide remote business, roughly growing the same, whatever. And then another issue I have is I've just started the Adobe position, which I do plan on kind of making that bigger. And I don't have any cash. So my entire net worth is invested in the market here. And the portfolio has done really well recently, especially given my age. Like this much money is a lot. But I'm thinking of like getting rid of HIMS. TMDX, I'm just fine keeping it there. Like it's a solid business, whatever. It's meeting its purpose. It's a small speculative bet that's growing fast. Things are moving in the right direction. HIMS, I don't like it because it's like a bit of a schizophrenic stock. It's just like volatile all over the place. Too much drama. I just don't want to deal with it. And then Pfizer, if it's always been a re-rate play, so I'm waiting for it to re-rate. But I mean, call it in the next like 2-3 quarters, I have maybe 7% of the portfolio that I could turn into cash here between HIMS and Pfizer. And then I would be more in favor of like finishing my Adobe position or finishing my Fair Isaac position, even though it's like up a little bit, right? Maybe it's a garbage excuse, but like I have other holdings that I want to prioritize building as opposed to SAF. And I have a feeling like the SAF opportunity is just always going to be there. It's like kind of in the camp of like an S&P Global in the sense of like it's never like too expensive, never too cheap. It's just kind of always there. Or like maybe Visa would be a better example. Like it's just always hovering around like a 27 PE. So I think I'll have a longer window of opportunity to buy into buy into Safran as opposed to like Adobe, which I think, any day now, like it'll start running like crazy. You get a narrative shift on it, it just starts running. Look at FICO, dude. It's up 20% in the past month and a half, right? Like these type of companies, in my opinion, the FICOs, the Adobes, you have to be a little bit more urgent, I guess is the right word for it, or more urgent to try to open a position and build your position quickly, as opposed to a SAF that's like that durable long-term compounder. Even if the stock continues to go up, I feel like the valuation wouldn't go up like crazy. I'd be fine opening my position at a later date. And again, I just don't have cash at the moment. So there's that. But I hope I answered it. This is top of the watch list for me. It's there. It's also European, so I'm not even sure I can buy it. Like I think I'll have to buy an ADR or because I'm 20 years old, right? So in IBKR, like you can't even. Pretty sure you have to be 21, I want to say, to buy international stock, something like that. So we'll see what the deal is there. But thank you for watching. Join the Discord. You have absolutely nothing to lose. Thank you for watching and have a great day.